The legacy of COVID-19 pandemic continues to linger in our lives today, as major countries are still trying to recuperate from the economic decline caused by the outbreak. The 2020 pandemic affected housing costs by changing the demand for housing. For instance, if a pandemic causes people to leave an area, the demand for housing in that area may decrease, which could lead to lower housing prices. On the other hand, if a pandemic causes people to flock to a particular area, the demand for housing in that area may increase, which could lead to higher housing prices. Pandemics can also affect housing costs indirectly through their impact on the economy. For example, a disease outbreak can cause a recession, leading to lower housing prices as people have less money to spend on housing. On the other hand, if a pandemic increases government spending, it could stimulate the economy and lead to higher housing prices. Today's video will discuss the housing crash predictions of 2023 and explain the reasoning behind these assumptions. The current situation. In recent months, high mortgage rates have caused some cooling in the housing market, which has seen record high home prices across the country. As mortgage rates have recently decreased, there's a disagreement among economists about whether home prices will continue to slow down or experience a crash in 2023. The overall housing supply in the nation remains limited, as those who recently purchased homes at low mortgage rates are choosing to stay put, leading to a tight inventory that has kept prices high and made homes unaffordable for many, particularly first-time homebuyers. While home prices are still high year over year, they are not as dramatic as they were in 2022. The direction of home prices in 2023 will likely depend on the trajectory of mortgage rates. Will mortgage rates continue to climb? There is a tendency for mortgage rates to go on an increase in 2023. A mortgage is a loan that is used to finance the purchase or maintenance of real estate, such as a home, land, or other property. The borrower repays the lender in installments, typically consisting of both principal and interest. The property being financed serves as collateral for the loan. Robert Johnson, a professor of finance at Creighton University's Heider College of Business, says that by the end of 2023, financial market participants expect that the Fed will have increased the target Fed funds rate by 175 to 200 basis points from current levels. That would translate into 30-year and 15-year mortgage rates at roughly 8.5 and 7.7%. As 2023 begins, housing experts closely monitor the economy, which is being impacted by various factors, including high inflation, high interest rates, ongoing geopolitical tensions, and recession concern. After a few years of strong performance in the housing market, there are signs of a correction, but it has been a slow process. Mortgage rates remain significantly higher than they were a year ago. Despite a decrease in total sales, nationwide home prices continue to rise on a monthly basis, making it difficult for many buyers to find affordable housing. According to the National Association of Realtors, NAR, the median existing home sales price in November was $370,700, representing a 3.5% increase over the previous month. This marks the 129th consecutive month of year-over-year price increases, a record streak, although home prices have fallen from their peak of $413,800 in June. So is it a buyer's market or a seller's market? Well, I'll briefly discuss the two terms, buyer's market and seller's market. When is it considered a buyer's market? In a buyer's market, there is typically more supply of homes for sale than there is a demand from buyers. That means that buyers will have more options to choose from and may be able to negotiate better terms with sellers. Some specific ways in which buyers may have an advantage in a buyer's market are, number one, lower prices. With more homes for sale than buyers to purchase them, sellers may be more willing to lower their prices in order to make a sale. This can give buyers the opportunity to get a better deal on a home. Number two, more negotiating power. In a buyer's market, buyers have more negotiating power when it comes to things like purchase price, closing costs, and other terms of the sale. Number three, more time to make a decision. Buyers will not feel as much pressure to make a quick decision on a home, as there are more likely to be other options available. This can give buyers more time to carefully consider their options and decide what is best for them. Number four, fewer multiple offer situations. In a seller's market, it is not uncommon for multiple buyers to make offers in a single home, which can make it more difficult for any buyer to succeed. However, in a buyer's market, there are likely to be fewer multiple offer situations, which can give the buyers a better chance of getting their offer accepted. So when is it considered a seller's market? A seller's market is a market in which there are more buyers than there are homes available for sale. This can lead to competition among buyers for a limited number of homes, and as a result, sellers may be able to command higher prices and have more negotiation power when it comes to terms of the sale. There are a few key indicators that a market is a seller's market. Number 1, low inventory. In a seller's market, there are typically fewer homes for sale than there are buyers interested in purchasing them. This low inventory can create competition among buyers and give sellers more bargaining power. Number 2, high demand. A seller's market is typically characterized by high demand for homes, and as there are more buyers than there are homes available for sale. This high demand can lead to multiple offers on a single home, which can increase the price. Number 3, rising prices. In a seller's market, homes are generally more expensive due to the high demand and low supply. Sellers may be able to command higher prices for their homes, and as a result, the overall price of homes in the market may increase. It is worth noting that a seller's market can occur in any type of housing market, whether it is a market for single-family homes, condos, or rental properties. It can also occur in any location, whether it is an urban, a suburban, or rural area. So who stands to make gain in 2023's housing markets? Buyers or sellers? Greg McBride, the chief financial analyst for Bankrate, says, affordability issues and economic worries will depress home buyer demand, and the inventory of homes available for sale will remain limited. So it'll continue to be more of a balanced market than tilting one way or the other. On the other hand, Danielle Hale, a chief economist, predicts that the 2023 housing market is expected to be more of a nobody's market with some buyer advantages. There will be 22.8% more homes for sale, but these homes will take longer to sell due to the challenging affordability conditions. The national median price for homes is expected to increase by 5.4%, which is less than half the pace observed in 2022. However, even with these high prices, homeowners are likely to walk away from a sale with significant equity if they can find a buyer. Overall, home sales are expected to be significantly lower, down 14.1% compared to 2022, as both buyers and sellers hesitate in a market and economy that is in transition. For many first-time home buyers, 2023 may not be the year for home ownership as the cost of homes exceeds their budget and income. As fewer households become homeowners, it is expected to be an increase in rental demand, which could cause rents to rise. The median rental price is projected to increase by 6.3% nationwide, although an influx of new multifamily housing may help meet some of this demand. Renters who are looking to save money in the year ahead may consider moving to the suburbs. The bottom line of the 2023 housing market. According to the experts, the real estate market in 2023 will be characterized by uncertainty and limited demand. It is expected to be a transitional year with tepid demand and limited inventory available for sale. However, there is a possibility that mortgage rates may decrease if inflation pressures ease. If mortgage rates do not change significantly, it is likely that there will be fewer purchase loans and a decline in rate-based refinance activity. On the other hand, if homeowners stay in place, there may be an increase in home equity loans and home equity lines of credit as people opt to remodel their homes rather than move. Those are the predictions on the housing crash of 2023. Please let us know in the comments your thoughts about this economic situation or if you have some concerns about the video. If you enjoyed watching the video, don't forget to smash the like button, subscribe, and turn on post notifications to get early access to economic and financial news.